Hey everyone, welcome back. Today, we're diving deep into the U.S. reefer freight market for August 2025. If you're a dispatcher, owner, operator, or logistics planner, this is for you. Rates are shifting, fuel costs are rising, and region-by-region performance varies widely. We've analyzed national trends, spot versus contract rates, and real operating costs. I'm about to give you the full picture, so you know where the money is and where it's being burned. Let's start with the national freight landscape. The average reefer spot rate for August stands at $2.30 per mile, which is down from $2.45 in July. Contract rates also slipped slightly to $2.68 compared to $2.75 last month. Current fuel prices hover around $3.80 per gallon, severely impacting margins. We clearly see a market cool down, especially post-summer produce and pre-fall retail. But where does that leave us? Let's unpack fuel costs, as they consume a huge slice of revenue. Trucks get about 6.5 miles per gallon. So, fuel cost per mile equal $3.80 divided by 6.5, which is 0.58 down per mile. That's around 25% of the spot rate just for fuel. Adding truck rental or lease costs about $0.60 per mile. Insurance, maintenance, and tolls add roughly $0.30 per mile. Total operating costs run between $1.50 and $1.60 per mile. That means a net profit at a $2.30 per mile spot rate is only about $0.70 to $0.80. Bottom line, you're barely clearing 30 to 35 cents per mile in net margins without smart strategies. Now let's zoom out and look at the reefer market over the past 12 months. August last year saw a spot rate of $2.40 and a contract rate of $2.75. In January, we reached $2.55 and $2. March brought us back to $2.30 and $2.75. In July, it was $2.45 and $2.78, followed by this month's $2.30 and $2.68. This shows peak seasons usually occur in January and July. August often dips due to lower demand after produce season, but before the fall surge arrives, contract freight remains more stable, making it safer for planning. If you're pursuing spot loads in August's soft market, you risk a lot. Next, let's break rates down region by region, as these vary significantly. In the Midwest, the average rate is $2.55, making it the highest-paying region. This market is driven by corn, dairy, soybeans, and meat, with strong networks in Chicago, Indy, and Minneapolis. Helpful strategy: it's great for outbound freight to or from this region. The West follows with an average rate of $2.50, bolstered by California produce and export shipping from LA, Phoenix, and Fresno. Here, be sure to stay vigilant as the produce season winds down. In the South Central region, rates settle at $2.38. These rates are stable thanks to Texas, Oklahoma, and Arkansas. For this area, treat it as a repositioning or contract freight zone. In the Southeast, rates have dipped to $2.25 after peach and melon season. It's not ideal. Only operate here with outbound freight secured. The Northeast is the lowest-paying region at $2.103, with high tolls and fuel costs. Steer clear of this area unless you're compensated well for going out. Now, if you're dispatching reefer units right now, here's what to do. Prioritize regions like the Midwest and West. Negotiate for stable contract rates to ensure your margins. Plan repositioning routes through South Central. Avoid the Northeast and Southeast to minimize risk. Look ahead to late September and October, as fall produce may heat up again in the Midwest and Pacific Northwest. To wrap up, August is tricky. Rates are soft, fuel's expensive, and mistakes cost money. If you got value from this breakdown, hit like, subscribe, and drop a comment below. Let me know how your trucks are operating this month and which region is working best for you. Stay sharp, stay loaded, and stay profitable. Catch you in the next market update.